my name is Maura Ginty. I'm a tax advisor and my firm is Gin Tax, and this is your annual tax update in half an hour. Today is your annual tax update for 2020, and I suppose if we're to summarise 2020, if I was to summarise the presentation in one slide or the year in one slide, I think this gives a flavour. A very busy year, but I suppose the main thing to note is that there's really been no changes, big domestic policy changes, in particular even having a change of government earlier on in the year. Then Irish tax really hasn't changed too much from this time last year. And what I propose to do today is just go through an overview of the Irish tax system, the various rates, reliefs, and give you a flavour of some of the topical cases, and indeed talk a little bit on the future. So we're nothing if not ambitious, and we'll kick off, I suppose, with just talking about the income tax rates. And here, a lot of you would be very familiar with the top rate, 52, 55%, and this is how we get there. And as you'll see, it's very quick. We're one of the quickest countries where we come into the top rates in around 30,000. We're nearly there at the top marginal rate for individuals. And I've just done up this slide just to illustrate, I suppose, the progressivity of the Irish tax system. And one of those notes, you'll recognise one of those salaries is seemingly the average salary of a chartered accountant per their Leinster Society. And just on the progressivity, basically what it demonstrates is that the more money you earn, then the more of that pay packet goes in tax. And you'll see the senior executive there, nearly half of their pay packet is going in tax. And I suppose the next slide is just to illustrate that individual. What are they thinking about when they're making an investment decision? And of two things, I suppose the first two bubbles there are as old nearly as time itself, the difference between classification of products with investment return, which would be taxable at the marginal rate, very high in this instance, or the capital gains tax rate. And I've put in one which is a lot more popular nowadays in the last 10, 15 years, and that's investment in funds. And that's can commercially make an awful lot of sense, in that funds is broadly an investment, a basket of various shares and products. So you get a lot of exposure and a nice diversified portfolio for one investment. And the good thing about them generally is that there's gross roll-up in the funds, so the funds themselves aren't necessarily paying tax. Now, the tax at your own level, I suppose, just to note, can be quite complicated. There's a blanket for Irish funds, a 41% rate. Foreign funds can be very complicated, classifying them for Irish tax purposes. So I just want you to be wary of that sometimes they can be funny for tax. And then on top of all of those, we also have the tax reliefs. And I suppose the next slide, I thought it useful just to illustrate the main tax reliefs available to the high earner, the salaried individual. And the good thing about all of these is that relief is available at that top 40% rate. And the first one is what we all know and love, is pensions. And I suppose just to note on pensions, at the individual level, then the tax relief is quite limited. It's age-based and around 20 or 30 grand per person. Whereas company contributions, there's a lot more flexibility if your employer contributes into your pension than you yourself. And there generally is no cap for tax purposes. There's various rules around it, but it's a lot more flexible. And what that means is that it's certainly one of the main advantages for self-employed people incorporating their own companies and that company funding their pension. And generally, as a rule of thumb, pensions, people try and aim for pension funding of around 2 million. After that, the pot becomes very inefficient, but up to 2 million is a very good result, just generally and commercially. The next one, probably a lot of you may have heard of it, is investment in Irish companies that qualify for this EIS relief. And there's a lot of rules around it, and I suppose it works very well theoretically, 40% cash back. The main, I suppose, sensitivity is that your money is clearly at risk. You've invested in Irish companies rather than private companies in expansion phase rather than blue chip quoted companies, we'll say. But I suppose probably around this time of year there's a lot of them knocking around, and probably even a good marketing plan maybe might be for them to kind of be promoted as investing in Irish companies and private Irish companies, a big drive that way. And I've also highlighted one which is really poorly publicised, and it's not so relevant for the salaried, ongoing long-term salaried employee, but if you're a salaried person and starting your own business, then this sure relief is very relevant, and you can potentially receive a refund of your payroll taxes for the last 6 years. Now it's buried in that revenue, the guidance on it is buried in that revenue guidance on the EIS scheme, and it's not that well publicised at all. There's been a lot of lobbying for it to be more publicised by revenue or whatever else, and I suppose maybe it's even up to ourselves as an industry to get it out there a little bit more. I know even the girl who, or even in pre-lockdown period, who does my nails would potentially have qualified for it. Now again, may have been small enough refund, but it is potentially out there for those people. The next one is another really lovely relief, again not so publicised, is investment refurbishment in homes in certain areas in cities, and again it probably should be targeted more. Again, it would suit probably young professionals with salaries who would probably like to live in the city centre in a nice high-end warm home, and probably market at those kind of individuals. Again, a very low uptake of that one. And I suppose the good thing about that relief is it can apply to your own home, so you don't really have the tax risk that the risk or the commercial risk that you have associated with the EIS one. And just for completeness, the various reliefs for, as I classify them, giving and caring, which can be quite broad and can apply to not even relatives, nursing home for anyone in your circle, for example. The next, I suppose, point to move on, and just for completeness, is to talk about corporate tax. And I suppose this is basically all you need to know on the corporate tax rates. And our 12.5% trading regime has not changed since really the turn of the century, and looks like it's here to stay. It's a fundamental block of our whole tax system. The one rate that tends to change time and time again is the capital gains tax rate, and that can cause certainly quite confusion with companies locating here, in that there's certainly an assumption that, we'll say, a premises which is used for the trade would qualify on disposal for the 12.5% rate, but that's not the case. It's subject to capital gains tax. Again, there would have been lobbying around trying to try and make those a little bit that differential a little bit less pronounced. The other ones are probably more for your 6 marker, and just for completeness, just to be wary of, and this is just I suppose an overview of the regime, of the corporate tax regime. You'll all be familiar with the closed company or private company rules, and these again haven't changed for years, and there's probably a lot more focus now, and probably will be in the future, on the professional services and the classification of activities as professional or not, which is there's probably merit in having a wider kind of discussion generally about that, given the I suppose the change I suppose in society as to how people work. And I just want to draw to your attention one thing that's kind of useful, interesting, just from cases and precedent. There's been a lot more drive on classification of activities or Airbnb type activities and indeed direct provision centres as more trading activities rather than purely rental. And that can have a real impact on the tax bottom line, because trading is 12.5%, but if you're into rental in those private companies, then you're into potentially those that 40% ultimate tax rate. And just as an aside, clearly those high rates for private companies just apply where there's a no dividends, and that dividends should be able to manage. The dividends should be able to be managed in a corporate structure. I suppose moving on, just to talk about capital gains tax, and I mentioned earlier on the default rate of 33%, and there's clearly reliefs available, and I suppose the main one, and probably one of the cornerstone of Ireland being an attractive regime for multinationals, is our holding company regime, our participation exemption 626B. It has various names, but broadly is 0% on disposal by corporate groups where conditions are satisfied clearly. The other one, which a lot of you will probably has got a bit more media attention of late, is the 10% rate for entrepreneurs who are actively involved in companies. Now that's capped at 1 million, but can be very useful for and very valuable to people in that market. So I suppose we're not in an ideal world, but ideally this would be a lovely structure for a client. And in that instance, the disposal, the individual would have, we'll say, 1 million proceeds, which would qualify for a 10% rate, 100 grand tax, and then the balance of the proceeds would be in holdco with no tax, and the cash would then just roll up in holdco. Clearly be subject to profits and gains be subject to tax in the holding company, and it's a kind of a common enough structure in the last few years, and works very well, because generally for those kind of big value transactions, individuals don't need the money in their own name. Generally that kind of 1 million or 2 million, if there was we'll say a couple who were involved in the business, is probably, they're happy enough in exiting with that cash in their back pocket. The other one I want to mention, and it's mainly for completeness, that you'll have all been familiar with this relief, retirement relief from your exams, and I suppose it works very well for the smaller disposals. There's an exemption for transactions when you qualify to 750,000, which is very valuable for that market. But generally the main benefit and the supposed main benefit of retirement relief is a complete exemption for transfer to the next generation of your business, which is all very well in theory, but just the conditions for the relief and the main stumbling block with retirement relief and that condition is the age. You can only do the complete exemption in the years from age 55 to 66. So I googled him, right? Everyone's favourite businessman, Michael O'Leary, is 59 years old. It was only very recently, I remember him being in the papers talking about having kids in nappies. And I think an individual like that, who'd be typical of the profile of an entrepreneur, business owner, is not going to be handing over the business to the kids in the next 6 years. And so what happens if you miss that 66 deadline? You wait for the ultimate, the big capital gains tax relief, which isn't even on that page, which is death, which is it's fantastic. There's no tax on death, and the person who inherits the assets has full market value based costs. Now, whether that's the best for the business with an 80, 90-year-old at the helm is certainly a moot point. I suppose I think it's probably useful at this phase just to talk about kind of cases or law cases of interest, which I think really illustrate for tax, I suppose, the nuances in tax and the various things that we as advisors kind of encounter just generally. And I suppose I'll start with the headline ones. These are very important Irish tax cases, and they went fairly high, either High Court or Supreme Court, and you made all the papers. And just go through briefly. The Domino's one is the age-old case of whether an individual, a pizza delivery people in this instance, are classified as employees or contractors, self-employed. The subway case is very interesting. It made international headlines, as a lot of you probably have seen, whether the sugar content in the sub is enough for it to be classified as bread or not. Seemingly not, but a very interesting kind of technical tax case, Supreme Court case, which kind of said that very useful generally for the taxpayer, and that there's a kind of a more literal interpretation of tax law is probably more the default in those kind of cases. And the other one, Perigo, which is Elan, you'd probably have known better, and this one will run and run. It was only recently decided on a technical point in the High Court. It's whether the sale of that drug to Salisbury is classified as trading, 12.5%, or as capital gains, that nuanced point that I mentioned earlier on. And a very important distinction, clearly, with the difference in rates. And it's been, the technical point may go to the Supreme Court, but in any event, it will run and go back into the default tax appeal, which is the Tax Appeal Commission. And I just want to spend a little time talking about the Tax Appeal Commission, because it was reformed in the last few years, and now it's very relevant and very interesting, right? And the main point of relevancy is that all cases now, all determinations need to be published, and they're published on their website. Now, the only thing about the whole thing is that the Tax Appeal Commission is very underfunded. So, for example, their website can be very hard to navigate. There's no index, so you kind of need to know what you're looking for. It's like lucky dip, if not clicking into various cases. But some of them are absolute gold, both from a technical tax perspective and also from a general interest gossip perspective. And I'm just going to go through, I'm just going to mention some of the more gossipy ones. Sale back in the mid-2000s of a 40 million shopping centre, which was seemingly down the country because we talked about valuers maybe up in Dublin. Another one, a payment to a publican. And our own profession, two accountants ones, which actually are probably good technical merit, and they will run and run. And they will run and run. The first one is a Big Four, and I'm not. Just as an aside, the business website, The Currency, does great synopsis of most of these cases, and has a nice synopsis of that one. It's more on a technical point, that one, on the classification of payments as charges or not. The other one is a lot more relevant, and back to that point that I discussed earlier about whether professional income, whether bookkeeping services are all part of the professional suite of services that accountants provide. There are a lot more ones that probably are a lot more relevant technically, and will run and go through the courts. We'll say doctors, setting up service companies and the VAT treatment of those, things like domicile levy and anti-avoidance rules. I suppose just as an aside, looking at the cases myself, a lot of them you wouldn't see any you'd wonder why the client would have been advised to proceed with the case. Wouldn't necessarily have seen either technical merit or indeed for the amount involved and the hassle. You would question the decision to proceed with that process. And I suppose I'm happy in the Q&A, if needs be, just to talk more about what the Tax Appeal Commission can and can't do and decide on in that regard, because it's something that probably needs a little bit more commentary and a little bit more, I suppose, just attention just generally in the industry. Moving on, we're quite ambitious here. I've got 3 slides on the future, right? And I suppose the first one, the future is now, right? You'll all have been familiar with the the international BEPS project agenda that's been chugging through for the last few years, and it's been implemented gradually into Irish law. And I suppose you don't need to know, right? It's very, very detailed. As a general accountant, you just need to know that this stuff is out there. Probably some would become a little bit more relevant for people going forward, in particular transfer pricing, which will. Last year it got a reprieve, the SMEs got a reprieve due to Brexit, but that is coming down the tracks, and that will be a lot more topical and probably relevant for us all in the next couple of years. The EU mandatory disclosure is also very important for advisors if you're advising on cross-border transactions. I suppose moving into the next one, and I suppose there's been a lot of talk about Brexit, right? And it's going to have big impact. So even just, I suppose, an example. My own business, if I'm advising a guy now, we'll say in Newry, on Irish inheritance tax. I issue him an invoice today. I have VAT on my invoice. In January, there's no Irish VAT on that invoice, and he has no obligations, personal advice, so there's no obligation for him to account for it. So there's a big differential there in cost, and you can imagine just that small thing could potentially give rise to messing going forward, and that probably is extrapolated out a lot more issues. Now, I fully appreciate that in the next 5-10 years that a lot of these things are going to be ironed out, and maybe even sooner, but I can just imagine that next year is going to be very tricky for all concerned, and all businesses want generally is certainty, and there's no certainty at the moment, it certainly is. It will be 2021 will be certainly the certainty is that it probably will be a bumpy year for people in that regard. Moving on to something a bit lighter, or not. I just think it's useful just to go through the Sinn Féin, and they've been consistent, in fairness, with this, the manifesto and the budget proposals, and just the three main revenue-raising ones. And the one that gets a lot of media attention is that tax the multinationals. And I just want to clarify one thing. The proposal, what they want to do is essentially, it was brands, the multinational brands were brought into Ireland, and there's tax allowances available for them. And as a result of the proposal, they will just, the deduction for the brands will just be spread over a longer period of time than is currently. That would be the net impact of that, of the proposed measure. And I suppose that has a real advantage from the Irish government's perspective, in that it's immediate cash inflow, and the Irish government, I understand, accounts for everything on a cash inflow basis. But we all know basic accounting 101, the accounts don't follow that approach. So I don't see any big difference in the multinationals' bottom line, because you'd imagine that there will be the deferred tax impact will balance the tax out. So for the multinationals, it should clearly have a cash flow hit and clearly a cost in that. But my take on it is that that's about it for the direct tax. On the direct tax side and the multinationals, and that big talk point that's often mentioned. The other ones are a little bit more straightforward, and again useful just to bring to people's attention is the gold-plated pensions, which is that 2 million that I mentioned earlier on pot. The proposal is to reduce that to 1.5 million. Probably a little bit more concerning is the proposal to reduce tax relief for pensions, which I suppose is fairly topical, and there's been lots of just general reports on it in the last few years. But there certainly would be a concern there as respects the employer's side and the flexibility there. The other one is stamp duty, and I suppose it's useful here at this point just to remind ourselves that only 3 years ago our stamp duty rate was 2% for commercial property. It's now 7.5%, And I suppose, just as an aside, that 7.5% also applies to where you put the property in a company, which is unlike boom times, where that was kind of a common enough transaction. And just as an aside also on commercial is very widely, as you know, probably very widely defined, and that 12.5% rate could potentially apply to business assets, goodwill, and indeed farms. Another one which I thought is kind of useful to bring to people's attention is SARP relief, right? And there's a proposal to eliminate it, but I don't think this relief is probably that well known or understood. And it applies in the bump and the blurb. It talks about highly skilled individuals, but actually the requirement is highly paid. If you're paid over 75,000, returning to Ireland or coming to Ireland potentially, then you qualify for this relief. So it could widely apply, for example, someone returning from the UK to work with the same group could qualify. And the impact of it, I suppose, if we just think about the individual, the executive on the 500,000, if she were to qualify for the SARP relief, then she would receive a refund of 50,000. Now that still would bring her effective tax rate to in or around 40% rather than 50. And that 40% is still a bigger chunk of her salary going out than someone on 100,000 who's in or around that effective rate. I suppose just one point before we finish up is I just want to alert you to various kind of resources, and I suppose for COVID supports the absolute best one is and the first stop is the Irish Revenue website. And I'll take this juncture, I suppose, just to compliment both the Irish Revenue and indeed this institute and the various other bodies in how quickly they were able to get these supports over the line, in particular in March. And it was really through that POE modernisation project that allowed them to quickly get that money out there. And it really was a phenomenal job. Nothing was ever perfect, but every week it moved and updated guidelines or whatever else. And people worked, and indeed every accountants throughout the country worked very hard to support employers on it. Just general tax resources, I suppose the Irish Revenue website has all the information that you will need, but you generally need to know and need to know what you're looking for. It's never something you'd advise someone just read the Irish Revenue website for an update on Irish tax. Our own institute, the Monday emails on tax are very, very good. If you've only a passing interest in tax, certainly around budget time, I'd really recommend to follow them at that stage. And just for general, I suppose, a general tax overview, probably the best resource that I've come across, and I've no skin in this game at all. If anything, my blood would run potentially KPMG blue, but the PwC, if Google it, the tax facts, it's like a 70-page document, and it covers everything from childcare services to anti-hybrids, and they update it around springtime every year. Half the year it's not completely up to date, but it'll give you a really good overview, and probably accountants at least once every couple of years have a good read of that document or a document of your choice. I'm sure the other firms at this stage produce them. We were ambitious, but I think we've kind of covered off on the main points. I suppose one key thing to take away from it is that it's very easy in tax to get bogged down in the detail. But I suppose the detail is the job, and that's my job, the job of a tax advisor. For general accountants and finance professionals, I suppose it's incumbent on you just to know the key rates that we've discussed earlier, the progressivity of the Irish tax system, and just have a general overview of the various reliefs that are available that I outlined. So for example, if you have a mate coming home from the States, to know about SARP, if there's someone in the office talking about buying an apartment in the city centre, to know about the living city relief. And even if there's someone, and it's often, you often hear loose talk of someone, a business owner talking about moving abroad and not paying tax, to highlight that entrepreneur relief 10% rate that's there on the books, and people generally, no one minds paying the 10% rate. I'm really looking forward to the Q&A session after. This is filmed on the 5th of November. We don't have a US president. Our finance bill is still chugging through the Dáil, but I look forward to seeing you on the other side. Thank you.